right, this is going to be a walkthrough of some problems that will help you with exam 3. So this is an exam 3 practice. Question 1, the following material standards have been established for a particular product. The standard quantity per unit of output, so 1.7 meters per unit. My standard is 1.7. My price, standard price per meter, 2.80. Fix this. Okay. The following data pertain to operations concerning the product for last month. So actual material purchase was 5,800 meters. Direct materials cost actual 113,680. Actual materials used in production 5,100, and actual output was 3,200 units. So this is units. Okay. What is the materials quantity variance for the month? So if you recall, figuring a quantity variance, we need to have the standard price times the standard quantity minus the actual quantity, or actual quantity times standard price minus standard quantity times standard price. So this one, in essence, we just took this standard price out, subtracted standard from actual, and then multiplied it by the standard price. I'm going to do it the long way. So the standard quantity for actual output is equal to the units, actual units times the standard quantity per unit. Let's see, what did I just do? Okay, let's do actual quantity, standard price. Nope, I picked the wrong number. That was the purchase. So this is the quantity used. Okay. And then the standard quantity. So to get standard quantity, we have to do the actual output times the standard quantity per unit. And I forgot to put that in parentheses. So there's my SQ. And then I multiply it by the standard price per meter. So there's my standard quantity times standard price. So the variance then is actual quantity times standard price minus standard quantity times standard price. So my quantity variance is 6,732. That is dollars. So I could have taken this times this and got that same thing there. Anyway, so to figure out favorable or unfavorable, I have to look at actual versus standard. So this is what I thought was going to happen. And actual was less than what I thought was going to happen. So this is a favorable, even though it's just the way I subtracted is why it came out negative. If I would have taken standard quantity times standard price minus actual quantity times standard price, and it would have came out positive. But the way I can tell that it is favorable is what I thought was going to happen and what actually happened. What actually happened is less than what I thought was going to happen. So that is favorable. All right, question 2. Kashan Corporation makes and sells a product called Mini Warp. One Mini Warp requires 1.5 kilograms per unit of raw material Jerchlon. Budgeted production of Mini Warp for the next 5 months are as follows. So I just copied those units down. There's my production budget. The company wants to maintain a monthly ending inventory of Jerchlon equal to 30% of the following month's production need. On July 31st, this requirement was not met. So July ending, anyway, was 10,400 kilograms of Jerchlon on hand. The cost of Jerchlon is $4 per kilogram. The company wants to prepare a direct materials purchase budget for the next 5 months. The desired ending inventory of Jerchlon for September is. So the way we're going to figure this out. So this production budget is in units. And we need to get to kilograms. So this is units of Mini Warp. And we need to get it to the cost of Jerchlon that we need. So September ending in units would be 30% of October's production. But that's in units. So I need it to get it to kilograms. So I'm going to take units times how many kilograms per unit. And now I can get it to dollars, which would be kilograms times the cost per kilogram. So the ending for September in dollars is going to be 44,280. So we have to go from units to kilograms of, so units of Mini Warp to kilograms of Jerchlon to the cost of the Jerchlon. And again, we know that 30% of the following month meant I needed 30% of October. Question 3. Odo Corporation makes a product with the following standard cost. They give me all this information, which I'm going to copy. I copied down below. The company reported the following results concerning the product in December. Oh, I didn't copy it down below. So 3, 7, and 21. 27, 20, and 14. And 0.75 and 0.75, 3. Okay, so I copied those things down. The company reported the following results, which means so originally based on output of 4,400 users. That was our estimate. And these are our estimates for our standards. And then these are our actuals. So actual output of units was 4,200. direct materials used in production, direct labor hours, direct materials purchased, actual price of raw materials, direct labor rate, actual, and variable overhead rate actual. Okay, what do they want me to figure out? The company applies variable overhead on the basis of direct labor hours. The direct materials purchases variance is computed when the materials are purchased. They want me to figure out labor efficiency variance for December. So I need, because labor efficiency variance is figured out by taking actual hours times standard rate minus standard hours times standard rate. So actual hours right there times the standard rate per hour for labor. And then the standard hours, remember, is going to take an extra calculation. So the SH is going to be the actual units times the standard hours allowed per unit. Where's my SH times the standard rate? So I'm going to take and subtract. I get 44,000 and actual is more than the standard or what I thought should happen, so that is unfavorable. Question 4. The TS Corporation has budgeted sales for the years as follows. Quarters. Okay. The ending inventory of finished goods for each quarter should be equal to 25% of the next quarter's budgeted sales in units. The finished goods inventory at the start of the year is 2,500. 4 pounds of raw materials are required for each unit of produced. Raw materials are on hand at the start of the year is 4,200 pounds. The raw materials inventory at the end of each quarter should equal 10% of the next quarter's production needs in material. Scheduled production for the third quarter should be okay. So ending finished goods should be 25% of the next quarter's budgeted sales in units. So I'm going to take the sales in units plus the ending finished goods. So they want us to find scheduled production for the third quarter. So in quarter 1, they gave me the beginning inventory was 2,500 units. So total needs minus what I've already got finished for beginning, what I already have on hand equals required production. Quarter 2, ending finished goods is the beginning finished goods from the month before. No, it's not. Ending finished goods is 25% of the next month's production. Okay, so I'm shooting for what is quarter 2's production. Total needs, add those two together. minus beginning. So beginning inventory for quarter 2 is ending inventory for quarter 1. Now I have my sales in units plus ending, which is 25% of quarter 4. Add those together to get total needs, less beginning. So beginning inventory is the same as ending inventory for the quarter previous. So then I will take my total needs minus my beginning finished goods. So I need to make 14,500 units. Question 5. The following material standards have been established for a particular product. So standard quantity per unit. Okay, I'm going to skip question 5 because it is identical to question 1. So question 1 and question 5 are the same. Sorry about that. I did not make this practice exam. Someone else did. Okay. Home Corporation will open a new store on January 1st based on experience from its other retail outlets. Home Corporation is making the following sales projections. So they give us cash sales and credit sales. Home Corporation estimates that 70% of credit sales will be collected in the month following the month of the sale, with the balance collected the second month following the month of the sale. So what that means is credit sales will be collected starting the next month after the sale. Based on this data, the balance accounts receivable on January 31st would be. So I really don't like this question because they don't tell us what the balance from December, what we still need to collect, right? They're acting like this is our first year. They have not given us any more data. So all we can figure out from the data given to us is that the balance on accounts receivable January 31st would be $40,000, the same as the credit sales in January, because nothing will be collected until February. And they did not tell us anything from the previous year. Question 7. Lawrence detailing cost formulas for its materials and supplies is $2,230 per month. So that's their fixed cost, plus $1 per vehicle for the month of November. The company planned to have an activity of 75 vehicles, but the level of activity was actually 25 vehicles. The actual materials and supplies for the month was 2,160. The spending variance for materials and supplies in November would be closest to. So I need to figure out what my standard materials and supplies should have been for the actual output. So again, they have a fixed cost plus, open parentheses, a variable cost times the actual output. So my standard cost for that output should have been 2,255. So this is what I thought was going to happen, and this is what actually happened. So I find the difference between the two, and it's $95. What actually happened is less than what I thought was going to happen. So that is favorable. All right, question 8. Moorish Incorporated bases its manufacturing overhead budget on budgeted direct labor hours. The direct labor budget indicates that 8,400 direct labor hours will be required in January. The variable overhead rate is $1.50 per direct labor hour. The company's budgeted fixed manufacturing overhead is $100,310 per month, which includes depreciation of $9,040. So all other fixed manufacturing overhead costs represent current cash flows. The January cash disbursements for manufacturing overhead on the manufacturing overhead budget should be. Okay, so the very first thing you need to remember is depreciation is not a cash transaction. So this fixed portion, we have to subtract depreciation from it. We also need to figure out what our variable is. So this is going to be two parts. So we're going to take the direct labor hours times the variable rate per hour plus the fixed manufacturing overhead minus depreciation. So figure out my variable, figured out my fixed, and added them together. So my cash disbursements will be $103,870. Question 9. Private hospital bases its budgets on patient visits. The hospital static planning budget for November appear below. They give me all this information and then they give me actual information. Okay, so I got those copied down. So here's my variable portion. Yeah. Okay. All right, what do we want to know? The spending variance for laundry costs in the performance report for the month is. So here's my actual laundry. So I need to figure out what's my standard laundry cost would be equal to the actual number of patients times the standard laundry cost. So to find the spending variance, then we will take the standard minus the actual, and we get 480, and that would be favorable because my laundry, what I thought I was going to spend is more than what I actually spent. So I actually spent less, and that's why that is favorable. Okay, question 10. Carter Lumber sales lumber in general building supplies to building contractors in a medium-sized town in Montana. Stating regarding the store's operations are as follows. So we have sales are budgeted at 380 for November, 390 for December, and 400 for January. So 380, 390, and 400. Collections are expected to be 70% in the month of the sale, 27% in the month following the sale, and 3% is uncollected. So there's 70% in the month of, 27% the next month, and 3% uncollectible. Cost of goods sold is 65% of sales. Right there. The company desires to have an ending merchandise inventory equal to 80% of the following month's cost of goods sold. Payment for merchandise is made in the month following the purchase. So ending merchandise 80%. accounts payable is paid the month following. Other monthly expenses to be paid in cash are $22,000. There's my other expenses paid in cash. And finally, monthly depreciation is 20% or $20,000. And we are ignoring taxes. So there's my $20,000 depreciation. Okay, we've got to figure out retained earnings. In order to do that, we're going to have to build a little income statement-ish for each month. And they want at the end of December because net income gets added to retained earnings. So put down my budgeted sales, and there's my retained earnings beginning is right there. So that's where I got the 295,600. Now here, I'm just going to add whatever net operating income I get here and dividends. We don't have any dividends, so I don't have to subtract anything. So each month, I'm just going to take beginning retained earnings plus net operating income. It's ending, then ending goes up to the next month beginning, and then add the net operating income. I figured that out, and we'll just have to go to December. Okay, so cost of goods sold, they told me it equals 65% of budgeted sales for that month. So gross margin is sales minus cost of goods sold. Bad debt expense is 3% of the sales. My expenses are about 22,000, and my depreciation 20,000. So net operating income then will be equal to gross margin minus bad debts minus expenses minus depreciation. So there's my net operating income. And again, like I said, I just added that to my beginning balance that I got for retained earnings right here. And then this ending becomes December's beginning retained earnings. Okay, so December, I need to take 65% of sales to get cost of goods sold. I'm going to drag that formula over. So again, sales minus cost of goods sold equals gross margin. Bad debt expense is 3% of sales. Other expenses are 22,000. Depreciation is 20,000. And then I'm going to drag this formula over. Then it's just gross margin minus the expenses equals my net operating income. So it's beginning plus net operating income equals ending retained earnings of 422,000. Good luck on the exam.